Thank you everyone for joining us. I'm Matthew Lumsden, Head of Distribution for Vanguard Australia. Today I'm joined by three of Vanguard's most experienced investment experts who will offer some invaluable insights into our economic and market outlook for 2017 and beyond. Jeff Johnson is Head of Investment Strategy and Research, Asia Pacific. Rachel O'Connor leads the Rates and FX team in the Asia Pacific region, and Duncan Burns leads Vanguard's equity trading operations in the same region. Between them, they can bring a real hands-on perspective to the investment and economic trends that will affect your client portfolios. Thank you all for joining us.
Happy to be here.
Thanks, Matt.
Before we begin, I'd just like to remind you that the webcast will run more efficiently if you close any other browsers you have open on your computer. We'll also be answering your questions, and we encourage you to continue to submit more questions throughout the webcast. Thank you to everyone who submitted a question ahead of time. We've chosen a few that represent some of the most frequently asked about topics. So let's get started. Before we look forward, let's recap. Jeff, did 2016 pan out the way we thought it would?
In some ways, yes. In some ways, no. I mean, it was certainly a year that tested the nerves of many investors. And certainly, with the benefit of hindsight, the best advice that we would provide ourselves and our investors 1 year ago would have been to go away, tune out the noise, don't pay attention to the markets over the course of the next year, because for those who did, they witnessed a correction early in the year, largely on the heels of concerns about a global recession and a correction in commodity prices. And then in the mid part of the year, there were obviously flare-ups and uncertainty and volatility relating to the Brexit referendum. And then more recently, we had uncertainty and volatility again because of a U.S. election result that was certainly not the outcome that many investors had prepared themselves for. But for those investors who have been able to tune out that noise and really maintain perspective and discipline, they've turned out with decent returns over the course of the year, about 3% for international equities, a little north of 7% for Australian equities, around 5% on bonds, which maybe even was a little bit higher than many investors would have expected at the beginning of the year. Low returns on cash persist, but for balanced investors, say somebody with a 70-30 mix, they've earned around 5.5% on a year-to-date basis. So certainly not out of line with what we might have projected about 1 year ago.
Thanks, Jeff. Rachel, can you give us a flavour of how the year has gone from a fixed interest perspective?
Sure, Matt. So point to point, you could argue that Australian bond yields over the year didn't do a lot. We opened the year at 2.8% and we closed yesterday at 2.79%. And that's a theme that's pretty common across most developed markets, but as we all know, it hasn't been a smooth ride. For the first 8 months of the year, we saw bond yields rally to new historical lows as a secular stagnation story gained momentum. Lower rates, even negative ones, were regarded as stimulatory, and there was little appetite for fiscal spending. Come December, though, the market's done a bit of about face. There seems to be a general recognition from central banks that perhaps monetary policy has run its course, and fiscal policy is in the driving seat. And as a result, we've seen bond yields back up about 100 basis points, which is the biggest sell-off in bond yields we've seen since the taper tantrum in 2013.
And I guess, Duncan, what about equity markets?
So focusing on Aussie equities, if we look at the headline index returns, we're showing up roughly 3% on the year. And if we're looking at a chart of that, it would basically be a slow wander from bottom left to top right. And the dividend yield on top of that is just north of 4%. So if we look at year-to-date returns, we're looking high 7s or in the 8% range, which is relatively attractive given the headwinds that the Aussie market faced this year, slowing China and things like Brexit. So all in all, a fairly solid year for Aussie equities.
And what do we see as the outlook going forward, Jeff?
Yeah, so sentiment has shifted. A few months ago, as recent as a few months ago, I think we would have, we felt like the outlook was maybe even a little bit overly pessimistic based on investor views that stagnating growth might be occurring or set to occur globally. More recently, certainly following the outcome of the U.S. election, we think the sentiment has swung maybe to be a little bit overly optimistic based on overly optimistic expectations of a growth acceleration. We're not sure that either mood is correct and that the right outlook is somewhere in the middle. We see growth stabilizing. We see labor markets tightening in many world economies globally, and that is leading to some upward pressure on inflation. In the U.S., we see this economy being resilient. It's entering its 8th year of expansion since the GFC, but it looks set to continue to grow, and with the Fed probably on a path to raise rates. Political uncertainty is going to be the theme that pervades, we think, in Europe for the foreseeable future. The ECB is doing what it can, but there are limits to monetary policy. In Australia, the economy is rebalancing, but it is vulnerable. I think we'll get into some of those vulnerabilities probably in the discussion today in the Q&A. China, we don't see a hard landing being the most likely outcome there, but policymakers, again, are going to have their hands full engineering a soft landing.
So, yeah, in terms of the bond markets, looking beyond 2016, I think we're looking for bond yields to be higher than what we've seen recently, but, still low in the context of history. The market's still running with this global reflation theme, which I think is fair over the short to medium term. But I think it's really important for investors to focus on the very deep structural forces which have shaped the global economy and interest rates for the last 4 decades, including, poor demographics, high debt, globalisation, and disruptive technology. Monetary policy and fiscal policy are both good cyclical tools, very effective at bringing forward demand from the future, but they don't actually have much impact on all of those structural issues that are facing the global economy today. And I think it's going to take some time for us to work through that, which means rates will probably be lower than what we're accustomed to.
All right, thanks, Rachel. Let's keep going. Duncan, equities?
And on to equities. If we were to look at PEs for the ASX 200, it's currently up around the 25 level. And if we look at that relative to the last few years, PEs have been ticking up for Aussie equities. Just back in 2012 or 2011, it was right around the 20 or 19 range. So that headline PE might be signaling an overvalued or a sell signal to you. But we've got a chart here we'd like to share from the Vanguard Economics and Market Outlook. And this is a Shiller-Cape view of PE. And what this does is it's a normalized PE valuation. And it's normalized primarily for inflation and interest rates. And what this chart shows us here over on the right, today we've got PEs in Australia, again with that low rate, low inflation backdrop, that are in line with historical norms. So with that read, we think that the outlook for Aussie equities is guarded but not bearish. And over the next 10 years, we think returns are going to remain centered in the 6 to 8% range, which is broadly in line with historical averages.
That's great. Thanks very much, Duncan. Now, let's turn to some audience questions. And, clearly one topic that's generated a lot of interest is the US election result. Immediately following President-elect Trump's unexpected victory, we saw a short-term reaction with equity and bond markets moving in the opposite directions. So has the US election result changed our longer-term outlook in any way?
Well, Matthew, this is the issue that is very much on the minds of many investors today. Within the investment strategy team, we have economists who have learned to be humble because forecasting is a very difficult business, and we really feel for the pollsters who really didn't seem to have the degree of voter populism and even concerns regarding income inequality built into their models leading up to the election. And it's also a great lesson for investors too. We saw how wrong the polls were, and then many investors who had forecasted that if Trump were to win, there might be a risk-off move in markets. We've seen the opposite. We've seen the opposite both with equities and with bonds. Now, what does it mean economically? Many of his policies we would expect to be pro-growth potentially in the short term. Things like tax stimulus, infrastructure spending, potentially even some of the deregulation ideas that he has in mind. Those could be those could boost growth in the short to intermediate term. Things that have us a bit more concerned and are watching very closely, things like immigration reform, trade policy, those might have the potential to be inflationary and lead to higher rates. We would caution investors from reacting overly to that. Many of these policies are going to need time to play out. We need to see what form his cabinet takes and what sort of advice that he gets. Certainly some of the outcomes are going to be subject to negotiation and probably even some compromise. So time will tell. We tend to find out quite a bit more in the first few months of a new administration starting in January.
And what do you think about the impact locally and what's the RBA going to do?
Look, to the extent that, Trump's policies become reality, I think they probably do more harm than good, which probably means the RBA's in an easing cycle. I mean, the US is our biggest trading partner if you consider it on a final demand basis, which means if the US is growing, whether it be by tax reform or infrastructure spending, then that's good for Australia's export performance. But if we do see a US-induced trade shock, that will obviously be bad for global growth, and it's a very small open economy, even more reliant on exports, then that would leave us very vulnerable, particularly if our largest direct trading partner being China was targeted.
Great, thanks Rachel. And I'm going to turn to some questions that we've received from the audience. So Adrian from Grimsey Wealth has asked, where do you see global bonds and fixed interest heading, and how much of the expected rises in US rates is factored into current pricing?
Yeah, sure, Matt. So, as I said, we expect rates to be higher than what we've seen recently, but still be relatively low in the context of history. We've seen the market sell off about 100 basis points, which I think is pretty fair, given where we're at with the global reflation story right now. I think if the Fed does tighten in December and their commentary is more balanced, then I think that does give scope for the market to rally and consolidate lower levels until we get some more clarity.
I think this is another one for you, Rachel. So should we go short or long duration with bonds? And what about government or corporate, given the issues with negative interest rates?
Well, given how much of the market has sold off already, and the implementation risk around Trump, I would be inclined to be at least neutral rates, if not a bit long. I think that's particularly true in Australia, where growth and inflation is still uncertain and the market's already starting to price in some tightening by the RBA by the end of 2017. In terms of credit, look, I think the relatively low rate environment means it's still supportive for the asset class in terms of the reach for yield and the low default story. However, I would caution investors if we were to see another sharp increase in interest rates that were sustained on the basis that corporate leverage, particularly in the US, is now very high and at levels very close to levels we haven't seen since before the GFC.
Yeah, just a couple things on that. I mean, I really agree with the comments Rachel was making earlier about some of the structural forces that our economies globally face, and we see that limiting the upward moves in yields over the intermediate term. The negative rates question is one that comes up all the time from investors. We would advise investors not to miss out on the opportunity of owning international bonds and picking up those diversification benefits. Despite the very low yields that they offer. They are, in effect, a diversifier within a portfolio, and for an Australian who is investing in those in a relatively high-yielding currency like the Australian dollar, when we hedge those exposures back, they're earning Australian bond yield-like returns there. So we would advise against not missing out on that opportunity, despite the negative rate headlines that you'll hear a lot about.
Great. Thanks, Jeff. Rachel. I think this one's for you, Duncan. So do you see increased volatility on equity markets over the next 12 months and beyond?
The short answer is yes, Matt. If we look back at the last 12 months or so, political uncertainty has driven volatility. And if we use the VIX, or the CBOE Volatility Index, as a reflection of future volatility estimates, we've seen that spike up into the 20s, 30s, and 40s over the last year from its present state of around 14. And looking out in the future, the political instability is still there. So we would expect to see some more spikes in the VIX here in the short term.
I'm going to stay with you, Duncan. So what about ETFs? Is volatility going to lead to wider spreads and further dislocations in the market?
So volatility plays a big part in trading and trading costs, whether it's ETFs or equities in general. And when we see volatility spike, we see spreads widen, we see trading costs creep up, despite added liquidity or added volumes running through the markets. And it's worth noting that today's markets are far more automated than they were, say, 5 or 10 years ago, and global correlations are up. So as volatility hits, we see that priced into the market more effectively, more efficiently, and more quickly than we have in the past. So we do see volatility having an impact on spreads and trading costs. But I'd urge those of you that can avoid trading during those periods of volatility to stay out of the market. It's hard to find somebody to step up to a block in periods of extreme volatility. And if you do have to trade, protect yourselves, avoid limit orders and stop orders, and stick with limit orders and make sure you're going to trade at prices you're happy with.
Great. There's a question here picking up on your comment about hedging, Jeff. So Glenn from Beachside Financial, would you advise hedged or unhedged investments for the next 12 or 24 months?
Well, when we generate forecasts, as you know, we like to do so over at least 5 or 10 year horizons. Making short-term forecasts is, in our experience, more often than not, a fool's errand and very difficult to do consistently. When it comes to currency, that is probably even one of the most difficult asset classes to forecast reliably, particularly over short periods of time. But I would break the question into two. One would be, with your bond portfolio, we should be hedged. We should really be hedged just about all the time. Because if you're not hedging your bonds, I'm not sure you own a bond anymore. You own something that has a bit more equity-like volatility, to Duncan's point.
Right.
With the equity exposure, if you have a long-term time horizon, we're comfortable leaving those exposures unhedged because there's a cost associated with maintaining those hedges over time. We recognize, though, that some investors might not have that currency volatility appetite in their portfolios, and sometimes that needs to be a assessment that they make for themselves if there's some amount of hedging that they need to suit their risk tolerance.
Okay, so let's move from currency to maybe global trade. So Tony from Hartley's has asked, what's the likely impact of the Trump presidency on global trades, especially between Australia and China? Maybe Duncan, Rachel?
I'm probably not well positioned to grab that one. I'll hand that off.
Look, I think it's hard to paint a pretty picture there, but obviously China is Australia's biggest trading partner, particularly on the commodity side, and to the extent that Trump does target China in terms of his protectionism, then I think that's not a good outlook for Australia.
Yeah. Anything to add, Jeff?
Well, I guess I just would advise investors not to overly react in the short term. There are certain policies that the president has more power than others to enact unilaterally. Trade policy and immigration policy is one of those where the president does have a little bit more latitude. At the same time, the evidence is pretty strong that overly restrictive policies towards trade and immigration could have damaging consequences for the U.S. economy and the global economy. And we've got to believe that sort of advice and that sort of counsel is going to be provided. Things like the TPP are looking more likely than not that they'll be revisited, potentially eliminated. That might leave some room for China to exert a little bit more control in this region. Certainly to the extent that its activity picks up, that could actually prove to be a good thing for certain industries in Australia that rely on exports to China.
Great, thank you. I'm going to pick up on this question from Michael at Smart Financial. So, if you look at our multi-sector funds as Vanguard's best thinking, continuing that discussion point. So, are we looking at changing asset allocation with the changing market environment?
Simply no. These portfolios are built for the long term. These are built to withstand various types of market events, even market shocks. They're built to endure for very long periods of time. They're really designed for investors with a 5, 10 or more year time horizon. That doesn't mean that we're not constantly reassessing those portfolios. We do that quite regularly. Probably the most involved we've been recently is just in rebalancing them. The market volatility that we've seen has meant that in order to maintain those asset allocations, we've been sellers of equities and buyers of bonds at these higher levels. That's a real embedded benefit of these diversified strategies.
Great. It seems like Trump's victory is getting a lot of attention, so maybe we'll ask this from Jeff at Astute. So given Trump's victory, what does that do to general consensus of emerging markets being the leader for growth in the next decade?
Well, I mean, emerging markets would be a place, I guess, Duncan talked earlier about valuations. Emerging markets, in contrast to Australian equities, which we would say is probably fairly valued right now. Some other developed markets globally, like the U.S., might look, maybe on the high side, not out of line with what might lead to a 6 or 7% return over the next 10 years, but we wouldn't be calling certain developed markets cheap, certainly. Emerging markets, in contrast, have valuations that at these levels, are on the lower side, at least relative to those countries that I mentioned by comparison. But there's also a lot of risk there. You have the risk of a Chinese hard landing. That's not our base case, but we see that as being reflected into that valuation at these levels. I'm not sure at these levels we would be calling for an overweight to emerging markets for that reason. There's plenty of risk there. I think we'd be recommending something like a market weight to emerging markets at this point.
Anything to add on that score, either Rachel or Duncan?
I guess the only thing I would add, I guess, is to the extent that you've seen investment into the region, the emerging markets region, this increase in yields, particularly in the US and other developed markets, you could see more flow come out of emerging markets into developed markets, which could put pressure on funding growth in those countries.
There's just a lot of unknowns. I mean, what is the economic situation? How is the economic situation going to play out in China? Mexico certainly, one of the countries that may be more vulnerable to some of the policies that are now being talked about post U.S. elections. So, as we've seen just over the course of the last year, very, very difficult to forecast these things in advance.
Okay. So lots of great questions coming through. So Darren from Align Financial says, why is the Aussie share market been flat for 3.5 years, and when will it continue to climb?
So as Darren points out, a 3-year chart of the ASX 200 looks quite lackluster. But if we were to line that up with perhaps MSCI All Country World Developed Market Index, it's actually tracking quite well to what we're seeing around the world in developed markets. And drilling down a little bit deeper, it's worth calling out that the Aussie market has been putting out div yields in the high 3, low 4% range, which would sum up to an average equivalent yield just north of 5% or just under 5% for the last 3 years or so. So some fairly decent returns there in the Aussie market. And in terms of a breakout or what the future holds, as I touched on earlier, the Shiller Cape slide that we've got in the deck there shows the normalized PEs are fairly valued. And looking out a bit more longer term in the 10-year range, we do see those returns centered around the 6 to 8% range for Aussie equities. So I can't answer the question exactly when we're going to break out, but the future is fairly attractive there for Aussie equities.
Great. Thanks, Duncan. I got one for you here, Rachel. It's from Prabeth at Host Plus. In this low yield environment where the next direction for interest rates is likely to be up, is it better to seek active management with respect to fixed interest investments rather than index based so that duration risk can be managed?
Look, what I'd say there is if you can find an active manager that can consistently pick the market and is low cost, active management is hard to argue against. However, timing the market is very difficult, and for the last 4 years or so, lots of people have been talking about bond markets being in a bubble, and you should be short, and we know how that story's played out. Rates have backed up, and I guess getting short now, you could save yourself some further capital losses. But one thing you do need to remember and think about is how much income you're foregoing by not investing in the term premium that's embedded in fixed income securities.
Great.
I feel like the bond market and our bond portfolio manager almost needs a hug, because when rates go down, investors complain about bonds because there's low or no yield, and when rates go up, they worry about getting out or manipulating the portfolio because of fears of a rate increase and falling bond prices. Higher bond yields is a good thing for investors. It ultimately produces higher income for them, and our forecast is not for inflation to get out of control. We still see inflation in the 1.5%, maybe 2% range over the course of the next 10 years. So they ought to do their job of providing the downside protection, the diversification, and probably even generate a small positive inflation-adjusted return.
Yeah.
Great. All right, I think I've got one for you, Duncan. So can you just give us a sense of how equity valuations are looking both locally and worldwide?
So I touched on the Aussie valuations earlier, and Aussie equities being fairly valued. If we were to line that up against global valuations in developed markets, they line up quite well. And the outlook, again, over the next 10 years for both Aussie and global equities in that 6 to 8% range over a 10-year period.
I think this one's for all three of you. Very much with an Australian flavour here, but we've been hearing about the end of the mining boom for a while now. So what's behind the recent rally on commodity markets?
Well, certainly following the result of the U.S. election and speculation around potentially substantial infrastructure investments, that's been extrapolated by some investors into the need for those sorts of raw materials to build the bridges or airports or roads or schools or ports or whatever it is that would end up being built. So that probably has something to do with it. OPEC's also gotten involved, maybe in just over the course of the last couple of days. I don't know if either of you want to comment on that.
Yeah, clearly they've come to agreement to cut back production, but I guess the other aspect of commodity prices is what's been happening in metallurgical coal, because that has a particularly strong impact on our terms of trade. That's risen about 110% over the last 3 months, and that's really got to do with China cutting back supply. They've been cutting back excess capacity in terms of cutting back on hours for coal miners, and there's also been some floods which has impacted inventory. So I guess the key message there is, yes, commodity prices are higher, but we do have to be cognizant that there are some factors at play that could...
And counterbalancing forces. Non-OPEC members might not come along at higher commodity prices, higher oil prices. It gets certain producers or explorers more involved. Think about the shale industry, for example. So again, we need to think about both sides of that supply-demand equation.
Yep.
I guess let's stay with an Australian flavour. So what are we likely to see on exchange rates over the next 12 months? What's the outlook for the Australian dollar?
I can touch on that. Look,
Great.
I guess,
Thanks,
to the extent we don't see like a significant correction in commodity prices, I would say the outlook for the Australian dollar is, pretty positive. There's a very high correlation between the Aussie dollar and iron ore and coal prices, and to the extent that we've seen the Aussie dollar really underperform the rally in commodity prices recently is actually very unusual, and probably driven by a couple of factors, being the strength in the US dollar and selling of high yielding currencies as rates globally have sold off. I think as we see that selling in the Aussie dollar start to dissipate, I think the market will start to refocus on that commodity price story, and we start to see some correction going forward.
Thanks, Rachel. So there's lots of talk about Trump, but what about Europe and recent events? Is it heading for a split up? You want to take that, Jeff?
Well, I mean, this has been on the minds of investors quite a bit, certainly since Brexit in July. Just this week, Italy had another referendum, and clearly, this populist sentiment was expressed there, and we're going to have another change in government in Italy. This is nothing new in Italy. Every year or two, we've become accustomed to this, but certainly the sentiment there has been towards thinking hard about its involvement with the European Union. So expect some volatility and uncertainty as Italy figures out its path forward. Next up is probably France. France is having elections next year, and there are signs that there are elements of the population there that are similarly frustrated with its involvement in the European Union.
Well, that's all the questions we have time for. Thanks again for all your great questions, and appreciate everybody watching, taking the time to log on. And of course, thanks to Jeff, Rachel, and Duncan for joining us and providing their insights. Hopefully you found the discussion beneficial, and if you'd like a deeper dive in any of the issues we've raised today, make sure you take a look at the 2017 Global Investment and Economic Outlook paper, which we'll email out to you. Before we wrap up, I'd like to remind you that the webcast has been accredited by the FPA, and you can receive CPD points by clicking on the survey tab to the right of your screen. This survey also gives you the chance to provide any feedback and offer suggestions for the future topics you'd like to hear about. Enjoy the rest of your week, and thanks again for your time.